Welcome, everybody, to the Chinchilla Picking Podcast. It is Saturday, November 13th, 2021. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am here with Brandon Beaver. Brandon, how are you doing today, man?
You know what? I've been sick all week. I'm starting to feel better. I'm still a little congested. I don't know if it was COVID. I didn't go to the doctor. I don't know if I have health insurance because my HR rep at the previous job that I was at before I received my severance started explaining the whole insurance situation to me, and I kind of blanked out and just started thinking about stocks because it was boring. So I probably should have paid attention to that. But just quarantining myself a little bit longer for a few more days now that I'm starting to feel better, just in case. I might go get the antibody test and see how that pans out. But right now, I'm feeling a lot better. I was having the cold sweats. I had the sore throat, the headache, the nausea, all that stuff. It was a really bad week, but we're ending it well. We're doing a weekend edition of the Chinchilla Picking Podcast, and I'm happy to be here.
Special edition just for Brandon since he was under the weather.
Yeah.
Special edition.
And I just ate a couple of Skyline cheese conies. And you know what? If you're in Cincinnati, there's some people that hate. So, you're doing the puke.
No, I'm just kidding. I'm just kidding.
I'm going to call an exorcist to get the demons out of you that are blocking you from enjoying this amazing goodness they call chili.
No, all right. Look, Skyline chili is great. The only time I ever eat any one of the Cincinnati chili places is when I have friends and family and from out of town.
Well, that's right.
Other than that, I don't eat it. That's right. They come here from California to visit me, and they're just like, "Ooh, let's have some of the Cincinnati chili." So I'm like, "Yeah, sure, let's go." Nice. Well, I was out doing some shopping for Toys for Tots today, buying some toys for underprivileged kids. Something I push every year, give back to local food shelters and missions and all that kind of stuff around here. It's that time of giving. That's actually one of the things I'm going to talk about is my experience out today and some of the things I saw and what I foresee going in there. But yeah, no, what do you say we get going? I'm going to kick off the show today. Cool with that?
Yeah.
All right. So what the guys the rules are the rules. Brandon and I get together 5 minutes before the show and we tell each other what we're going to talk about. We do not discuss it. We saved a live discussion for your ears and your ears only. That way you can hear that interaction and see the, ups and downs of the show, if you will. I don't even know what to call it anymore. But yeah, the flow. Here we go. There you go. But today I wanted coin toss, and so I get to go first since it is college football Saturday, and that's usually what I'm doing right now. I'm going to use college football terms here. I'm gonna receive the kickoff and lead here. All right, Brandon. So when I was out today, and we were out shopping about, I was out with my daughter, and we're getting all kinds of stuff, buying toys for, like I said, Toys for Tots, and picking out different things. I saw a number of things that were some surprising, not surprising, right? One of the surprising things I saw, because it's only November 13th, was that the traffic in these busy shopping areas was just like it was mid-December from like just the past 2-3 years ago, pre-pandemic, mid-December. And that's what it was like out there today. You had to park 2 miles away from the stores and walk into everywhere, and it was just crowded, and there was lines. And we were at Target at one point, and there was almost every single cashier station had someone there, and there were still lines. You just couldn't get through. It was packed everywhere, and I believe that's just people who are panicking, worried they're not going to get their items. Because of everything they're seeing on the media, everything they're seeing on the news, and they're seeing it. And you know what? I'm not saying the media is lying. I'm not saying that at all. There are supply chain shortages. There are supply chain problems, and if you are looking to buy Christmas gifts for people this holidays, or holiday gifts, whatever you want to call it, there's definitely a need to plan ahead a little bit. But this was very much like pre-pandemic, mid-December traffic we saw out there today. What are your thoughts? Do you think that's going to translate? Here's my question for you. Do you think that will translate into, I'll give you options. A holiday shopping season that lasts longer, therefore more sales in the retail stores do better? Or do you think it would be B, people jump in now, then after Thanksgiving and the traveling and all those visits, and they start to die off and we don't have many sales come December? Or do you think C, this is just one big jump in right now and we're going to be overall, dead for the holidays?
B.
Okay.
Yeah, I think we're pulling forward a lot of demand. That's what I think's happening.
And that term pull. So let me define that term pulling forward, people. Just for people who, Brandon, people like me who are not as smart as you, I know I would need a definition of that. And what does that mean, pulling forward? What that means is sales that usually would have happened in December, we're pulling it forward to November. So it's a simple term, but we're taking sales that would have happened a month from now. We're creating those sales now, that way, because of the supply chain shortage. But go ahead, you were saying something.
Right. Like, I'm not going to go out and buy 2 PlayStation 5s because of this. I'm still going to buy the 1 PlayStation 5 if I find it. And I'll buy it as soon as I find it because of the shortages. And it's funny because I think that we used to kind of do holidays like this. It was all right around Black Friday. Everybody had to get their holiday shopping in as early as possible. But with the invention and the maturity of e-commerce, then all of a sudden shortages and being in line on Black Friday wasn't as big of a problem. Now it is, because we've got these supply chain shortages and people are worried about that. So I think e-commerce and in-store brick and mortar retail sales will be pulled forward more in this month than you'll see more sales this month, I think, than you will in December.
And I also agree with you on this. And if they could get the supply chain worked out, they actually might have a great December too. Here's what I saw also. I want to cover this because this is the second thing. I said there was 2 things I saw and I noticed, right? Second thing I saw and I noticed, and I'll talk specifically about different areas here. The Lego aisles at Target, they were half empty. And it's mid-November. And they were half empty. That is a sign that we may run out of some of these toys. We may run out of some of these things. And, if you're one of our listeners and you're thinking about getting a gift, you might want to actually think about getting it a little earlier to make sure that you actually get that gift for your loved one or your significant other there. Because I saw shelves that were already empty in different areas, not just that section, but other sections as well, and then there were some areas that were so well stocked, they were bursting at the seams. So I think it depends on where they're coming from and then, how they're being shipped. And so some things are going to be in stock, some things won't. It's hit or miss.
Mm-hmm.
And so because of that, I don't think we're going to get the A strategy, which was a great overall holiday season where it's just, everybody's profit levels and revenues are way well past expectations because we're shopping early. I think it is going to be more of we get a burst now, things calm down a little, and we get small little bursts going forward into the final couple weeks.
Right.
So, saying that, is it too late to buy a retailer then? Or would you buy a retailer knowing that this is what we're seeing right now in the stores right now? Are retailers, is it already priced in? Do you think it's too late? Because here's my opinion. I'm going to say it and then I'll let you talk. My opinion is all the moves in retail are already priced in. Goldman Sachs already bought Macy's if they were going to buy it. I'm not saying they were, but if they were, they would have already bought it by now and waiting for everybody else to buy it off the good news.
Retailers are generally victims of inflation, and that's going to kind of lean into what I'm going to talk about a little bit later when we're done with the subject. But higher wage costs, things like that usually eat at the profits of retailers. You can go picking and looking for good individual stocks. Costco would stick out in my mind. they were way ahead of this wage inflation game. They were already offering higher pay to their employees than other companies were, and they can eat that cost a little bit better. But retail in general, I wouldn't go out buying any retail ETFs based on this, just because inflation is going off the charts right now and operating costs are as well. And you want to kind of pick the sectors that are going to benefit from that, not be hindered by it. And I do think that the holiday season is priced into a lot of these chains already. So
Good. So we're in agreement. We both think holiday season's priced in to all the chains. The ones who are going to be winners were already winners. And when the good news comes out, people are going to sell.
Yep.
I mean, not people, the financial firms that are already invested are going to sell and, sell the news. They're going to do it correctly. Right. Which is what we talk about on here. But yes, inflation is going to be a big, huge hit. Wage inflation, higher wages is a direct hit to the bottom line of any business, man.
Really, if you're thinking about this in a contrarian style, really the best time to sell would be right now when they're buying into it, because then you're selling into strength and not into weakness, which will be selling into weakness, I think, in December.
Ooh, really?
Or at least in the end of December. So
right.
Once the holiday season's over, then, those numbers that you're seeing on the Q4 reports will have already been priced in and then priced back out of the stock, I think.
Yep, I agree. I believe in the holiday season, it's weird, but I haven't watched the stock market for over 10 years. During the holiday season, what you said is the goal. I'm going to use Goldman Sachs again as the hypothetical example here. They've already bought into the company. And then after the news comes out, they sell, and they've already gotten out of the company, before the end of the year usually. So they've already made their move. They've already gotten out. So if you're looking at these retailers at the end of December, you've already missed the boat unless there's other news that is coming out about what a retailer's planning to do, or same store sales or something like that. I have no good transition to the next topic because it's completely opposite, but I want to transition over. So we'll leave that because I know you're going to touch on inflation, wage inflation, and those things later on. So we'll probably circle back and hit maybe some of those points again. But I want to switch gears completely in a different direction. And everybody this past week or 2 weeks has been talking about Facebook Metaverse, about VR. I know that 6 months ago, Chinchilla Picking Podcast, we spent a good 30 minutes on one of our podcasts talking about VR. And, 7 months ago, we covered VR and where the growth is going to be and all that. So we were ahead of everybody else. I just want to point that out. But anyways, nonetheless.
We were also telling everybody inflation was coming.
Yes. Yeah, we did. We called that early as well. Nonetheless, everybody's now talking about it. So when all the analysts are now talking about it and they're starting to push things, that's usually when I want to sell and get out. So on our 10-minute break this past week, that's when I made the announcement that my NVIDIA position that I've been holding for a while, I pulled out all my principal and a good chunk of my profits, and I left very little in there for a long-term play because I think it's a good hold to have some money in it. But I did pull out, and the reason is when I start seeing every analyst out of the woods here calling plays on Metaverse stocks and that's when I'm like, okay, everybody's now jumping in and they're trying to pump up these stocks. I'm pulling out. I'm getting my money out of there. I've already made my profit. I've already made my money, and I'm moving on. And it makes me concerned. And I thought this week about what you had said, and you had brought this up was. What's to stop Google from doing its metaverse? What's to stop Apple from doing its metaverse and doing this? And I made the point, like, great, let's do it. Let's all have these different competitions. You don't want a monopoly. You don't want Facebook to have the only, VR field or VR metaverse, if you will. They may not even be able to patent that name. You know what I mean?
Mm-hmm.
So that name may be used like Xerox. How Xerox lost the rights to its name. Let's make a Xerox. Everybody's going to be calling it a metaverse. This is the Google metaverse. This is the Apple metaverse, so on and so forth. Anyways, One thing I was thinking of is like, why doesn't a company like, and I'm just going to use this as an example. There's other examples out there, but why doesn't a company like Activision Blizzard make a World of Warcraft metaverse? You know, or like you brought up, I'm going to steal your thunder here. Take Two Interactive do a Red Dead Redemption metaverse
Or Grand
for
Theft
VR.
Yeah, or 6.
Yeah, they have it already, but they don't have it in VR. And that's what they're talking about, and that's what everybody wants to see is actual. I go into VR, and let's say let's use the World of Warcraft. I'm in there, and I'm my guy, and I'm walking around the world, and I go into a shop, and I go in there, and I can actually talk to a real person who's selling stuff, and I can use my cryptocurrency, whatever the cryptocurrency of that world is, and use it to buy and sell different things, and it becomes a real market. And no longer is it just a pretend market? You're talking to an NPC. No, there's someone who wakes up every day, puts their headset on, logs into that shop every day, if you will, and they sell their stuff to other VR players. And now you have a virtual business, a virtual market. And this is something I definitely see happening if these other companies can make this happen. And this is going to be how some people make a living going forward, is running these shops.
Crazy to think about.
I know. I thought we were further away from this than what we are, but we're actually only now just 2-3 years from some of these metaverses being up and running. In the Facebook metaverse, you're going to be able to go to a Nike shop now and pick out Nike clothes and talk to someone who's logged into the virtual reality of Nike, and and do that. There's going to be these different things, and I just don't know. I mean, these companies aren't announcing anything. So who do you play? Do you buy Activision Blizzard? Because the World of Warcraft, what do you? I don't know what you want to call them. Fans, players, community. The World of Warcraft community is huge.
Yeah, well,
and that would be a big play for them.
You can buy them. You can buy Take Two Interactive too. I think that any open world concept style of video game in the metaverse would be absolutely mind blowing and very fun to play. Living as your virtual self in one of these worlds would be great. My number one pick for this is, and probably will be for a long time, the company that now has it in its name. It's Meta. And I know a lot of people are saying, well, $10 billion, they're spending $10 billion on investing in the metaverse, and that investment's going to increase over the next several years. That's pocket change to Facebook. So I'm surprised it's not more than $10 billion. I'm glad it's not more than $10 billion, but I think the less speculative play right now in a company that's still pretty far off of its all-time high would be Meta.
Yeah.
You still have the regulatory headwinds with, Facebook and all of that, but I still like it for the long term personally.
Yeah. And the timeline on seeing some results from any of these hypothetical situations are years out, guys. Mm-hmm. I'm not saying this is going to happen next month. You buy it and it's going to jump next month. No. But these are things I think about. Like, do you buy Activision Blizzard as a long-term play, thinking the World of Warcraft is going to go live? The day they make that announcement that they're going to start creating this, which they probably already are, but the day they announce it publicly in a public news announcement, the stock will jump 5-10%.
And most of these companies are talking about the metaverse now in their earnings call. I just listened to Tencent talking about their metaverse strategy. They have a large percentage of Epic Games in their portfolio. They're a big player in the gaming industry, and so I think a lot of these other companies are going to follow suit, like Take-Two and Activision. Call of Duty in the metaverse would be pretty sweet.
Well, I mean, there's games like Call of Duty already in VR world where I could log in with 10-20 of my friends and we can all shoot at 10-20 random individuals in the VR world and have fun at it. I was doing it years ago, where it was like, to be honest, I was one of the few Americans playing that game. I was always logged on with Australians and British guys, and a lot of people from Asia and that continent, and it was a good time. And we, but Yeah, it's
You know,
it's been around for a while.
there's a war game called PUBG Mobile that in the metaverse would be pretty sweet too.
No one plays PUBG anymore, dude. Come
Oh,
on, man.
yeah.
You're just embarrassing me now. Oh. All right. So I just wanted to talk a little bit about those. I don't really have a call for those this week. For real, right now, my one I'm watching that if I make a call to buy on it would be Riot. I bought that recently off the Bitcoin news. I knew it would continue to skyrocket, and it has. I sold, but I'm waiting now. I'm holding in a holding pattern, watching it just because I'm watching what Bitcoin does over the weekend. If Bitcoin continues to rise, which I think it will, it might hit 75 by the end of the year. Right, it's definitely a good play to play off of Bitcoin. I wrote a whole article about it on our website, how I traded Riot and how it was related directly to Bitcoin. So Bitcoin moved like 5,000-10,000 up, Riot moved 20 points. It was ridiculous the moves that Riot was making. And likewise, if Bitcoin dropped 5-10 down, Riot dropped like 20 down. So it was very a direct relationship between those two, and that's one way to play the Bitcoin bubble. Anyways.
Yeah. Well, I have a call on Meta, and it's by Meta.
By Meta.
By Meta.
I know you have. I know you've called Meta, and that's your play.
Yeah, and the TV analysts are still fairly cold on it. And a lot of them, not all of them, but a lot of them are idiots. So,
well, it's because they still look at Facebook or Meta. They still look at Meta as just Facebook and Facebook only, and the ad there and the legal trouble Facebook's in right now. Whereas Meta is there's more to it than just Facebook.
I don't hold punches. I don't hold back on these people, but the one guy that's got it right now, give credit where credit's due. And Jim Cramer is telling you to buy Meta, and he's right.
Whoa, Brandon Beaver agrees with Jim Cramer. What just happened here? Brandon, take it over then, since you're going on about Meta right now. Take it over. I'm done. Go ahead.
Well, I like to sometimes sit back and formulate a strategy for the market. I think everybody should. And, maybe 4 or 5 times a year, maybe more if needed, you sit back and reevaluate your strategy, figure out what's working, what's not working. And a lot of that is figuring out the micro, of your companies, listening to the earnings call, reading the balance sheets, all the financial statements, things like that. But a lot of it too is you want to try to figure out where we're at on a macro basis. We don't always know where we're going. We don't have crystal balls or anything like that, but we can figure out where we're at, and that's important. I'm not here at my desk with 6 monitors that I wasted all my money on, reading my cluster of funny squiggly lines that will magically tell me the future. I'm not Miss Cleo.
Other
YouTube traders might pretend to be, but we can put together strategies and based on the data that we have and the information. And
Brandon, I always love to challenge those traders that have the 6 screens up and their swivel mic, and they have the nice cool seat and all that stuff, and the high-tech mouse. I say, look, man, let's have a challenge. You versus me, make picks publicly ahead of time, own them, and then publicly say when you're gonna sell and not sell, and make it public, you versus me. And I bet you with my phone alone, I'll outdo you any day of the week.
Yeah. Most of the time you have to, I think about this, like most of the time, those 6 monitors or 4 monitors or whatever it is, they have on their desk, that's for aesthetics. That's to sell their program. That's to take a picture of it or to take a video of them trading on those with the ticker symbols up and stuff like that on TikTok. And they're trying to sell you a monthly program. That's what they're doing. That's why they bought the 6 monitors. It's not because they're useful, because they're not.
They're trying to sell you their Discord group. Join my Discord group,
Even if you need to multitask, one monitor does that now.
It's true. That's true. Yes, it does. Yes. Yeah.
Although I do like the Money Vikings Discord group. I'll throw that out there we're not taking a shot at that Discord group.
No. And there are good Discord groups. There are good this. It's just we're taking a shot at that. Now there's a million different people out there saying, hey, I can make you X amount of dollars and I can make you this. Join my Discord group, and we'll make you very rich in a matter of a year if you just do what I say. And it's like, that's not how it works, man. You can't tell people you're going to make them rich in a short period of time if you join by just joining your Discord group. I mean, come on.
Yeah, and they have stock photos of Lamborghinis.
Yeah,
Look, Lamborghini, join my Discord group.
or they rented a Lamborghini, or they went to a car show and they sat on the hood of somebody else's Lamborghini. And we all know the tricks. We all know what they do and the tricks and the things to look through and see beyond. And it's all fake and it's just for show. And I feel sorry for those people, but let's get to it. Let's tell people how to make money. Let's be different. Brandon, go ahead.
Okay, so where are we in the market right now? We're in the final quarter of the year, and that tends to be the strongest for the bulls. We're looking at the Fed planning to begin tapering at the end of the month. Now, according to the September FOMC minutes, the Fed hopes to slow buying by $15 billion per month, including $10 billion in treasuries and $5 billion in mortgage-backed securities. It's kind of a small percentage here, so we don't want to really overreact to it, but it's something to keep in mind, and it's a trend that's probably going to be happening for the next couple of years. Now, if mortgage lenders aren't willing to loan money out at current rates, mortgage rates will have to rise in order to entice lenders to loan out money. That sounds awful. It sounds like, okay, mortgages for people who are buying houses, the interest rates are going to rise. That sucks, right? But housing prices have been on the rise. They've been on an absolute tear. And if you're looking to buy a house, you're buying right now at like very, very, very hot prices. So a rise in mortgage rates is likely to negatively affect demand, which will incentivize sellers to bring down the price of the house they're selling. So in economics, things often equal out a little bit. This is one of those situations where home buying, the prices are going to be a little bit better, even though the interest rates are going to be higher. Now, caught in the middle of this for the short term will likely be home builders who, if they have to bring down home prices to attract home buyers, might feel the squeeze between new home prices coming down and higher building costs. However, a major driver in material costs rising has been the hot housing market. So a slowdown in demand for housing might actually bring those material costs down over the longer term. So you might have some short-term pressures on the DR Hortons and home builder stocks, but over the long term, I think in this situation, they're actually going to be fine because the housing market cooling off means that material costs will come down as well. But we can pick some clear winners in this situation. With inflation, wages going up, costs of operations going up and stuff like that, you want to look for winners. And the winners are the companies that have their markets cornered. Now, there's a specific list of steps that's widely used, but it was compiled by us over at chinchillapicking.com and the article, How to Grade a Specific Stock. Link in the notes section. I mentioned this a lot. It's very important. It will, in essence, tell you if your company has its market cornered. The devil is sometimes in the details. Sometimes it's in rising SG&A costs. But the gold could also be in the details as well, maybe in low depreciation costs. So look at those financial statements, use the list that we provided to grade your stock, and you can find companies that are able to pass off costs to the consumers and able to eat the extra costs. Go ahead, Dave.
All right. So you covered so many things there, and you went from a couple topics and a couple different discussion points. First thing is like the home builders, you're calling for, if the mortgage rates go up, that home building is going to go down, and that we'll have less mortgages going out because mortgage lenders we're going to be either doing at a higher rate, so you're going to have less people buying, or they're just going to constrict on who they lend to because the government's no longer buying their mortgages at will.
Not as much. They're still going to be buying. There's still a large portion of the Fed balance sheet going to this, but it's going to be diminishing over time.
Right. And I always had I've had an issue ever since we started this podcast. I've complained about the federal government buying billions of mortgages every single month. And it's a market that's been propped up by the federal government, and that's the only reason why a lot of these people have given out mortgages to a lot of these subprime consumers. And it's not a smart business play, but you don't need to be smart in business when they're being bought up by the federal government. You don't have to be smart. You just give a loan out to anybody, and the government will buy it. And so I'm glad that the government's winding that down, and now these businesses, these companies will actually have to be thinking about who they lend to and who they give mortgages out to, which is a good thing, I think, for the economy. We have less defaults that way, and less people in houses they can't afford and over leveraging themselves in debt, which is a bad thing. One is more home builder guys. If you want to follow what Brandon said about these steps of looking for a company, a good company, one that can withstand inflation, following the guide that Brandon has referenced many times. If you want to follow that guide, some of these other home builders are, besides DR Horton, you got KB Home, you have Lennar, also in the related to the mortgage industry, because whenever there's a downturn in home building and mortgages, people typically tend to shop more at Lowe's and Home Depot because they do more repairs and they try to fix up their home to make it last longer and feel better. These are things to look at. Follow the guide. When you find a home builder you want, say you're looking at Lennar, or and you want to know if you want to buy or sell, follow the guide, look through the steps. Is it the right time? Take in those considerations, and then maybe just watch it for a little bit. Go ahead.
Now, I mean, if you're looking at let's rewind just a little bit. Think about the perverse incentive that the Federal Reserve offers by buying up these mortgage-backed securities. It's great to have a lower interest rate in theory that's driven by the Federal Reserve, because it makes it feel cheaper, but it's not. You could rewind the clock 30 years ago and say people 30 years ago were paying 10 to 11%, sometimes a lot more even, on their mortgages and interest. But look at what's happened to the price of housing. The prices of housing has gone much further up. We are getting a much worse deal on housing over the long term because of these lower interest rates. Because what people start doing is they start buying houses when the interest rates go low. It drives up the demand. Once you drive up the demand, then people start looking at real estate and housing in particular as investments. And once that happens, then more people pile in that otherwise wouldn't be doing so into buying houses, and they drive the price of housing up even further, much further than where it should be. Even worse, then you start getting people into buying houses to rent them out at higher prices. So the people that are getting really hurt are, well, home buyers, but then even worse are the people that don't have credit to buy a house and they have to rent because they're paying even more than we are.
Yeah, the renters are really getting the short end of the stick here.
Yeah.
When you go through that whole scenario.
I would rather have a higher interest rate on my house with a lower cost that I have to pay over time than having to buy a house in a hot market at top value.
Yep. And the people who rent, they're the ones that they are going to suffer. They're typically the lower income people. As far as like these new initiatives and have every car be electric car, I've mentioned this before on the show. What are you going to do with people who rent in apartments? Those are lower income people. They can't plug their car into their apartment. I mean, like, how are you going to force these people to get an electric car? But then, I mean, they don't have a garage.
Right.
The system's not set up for this. You can't force everybody. I'm for helping the environment, right? Right. I don't care, what your stance is, Republican, Democrat. It's fine. I like helping the environment. I like doing good things to help out, but we have to think about these things, guys. We can't say, all right, in 2030 and beyond, there's going to be no more gas cars. Those of you who are poor and low income people who live in taller buildings, condominiums and everything else, deal with it.
Yeah.
No, I mean, come on.
There's so many side effects and so much collateral damage that happens to these grand ideas by central planners. But let's talk a little bit more about the winners in this situation here. And winners.
What companies are the winners? Which ones we should be buying?
Rising rates, okay, are good for banks and insurance companies because they get to increase their margin on the spread between borrowing and lending. Lenders will have less competition in interest rates as the Fed starts to slowly back away. I love my Berkshire Hathaway. I've talked about them as a buy. I've been in them for a while. First show we put out, I said Berkshire Hathaway's buy. I'm still sticking to them.
Are they a bank though? Do you consider them a bank or an investment firm?
They're a conglomerate and they own so many different things. This is why
I call them an investment firm, not a bank.
yeah.
And I split that up, Brandon. I'm going to challenge because I'm going to challenge you on this. They're not the same.
But they're not a bank, but they own banks and they own companies.
All right.
A large portion of their income comes from their insurance division too. But the reason why I like Berkshire Hathaway, we've covered what's been going on with the 10-year yield and the treasuries. There's been so much craziness going on with the yields that it's been rather unpredictable. So I'm thinking that these rates are going to go higher, but they may not, because who knows? Some Japanese investment fund may jump in again and drive these things back down. That's what happened the last time. So who knows what happens here? But on the other end of this, Berkshire Hathaway also owns, Apple and Amazon, and they're heavily diversified. So I think no matter what way we go macroeconomically here, Berkshire Hathaway to me is still a clear winner.
Gotcha.
So there's protection there no matter what happens to the rates. We were talking about this before the beginning of the show. I like this underknown company, underpaid attention to. I can't come up with a word for that right now. But anyway, Allegheny. And I can never pronounce their name right.
Allegheny, like the mountains.
There you go. I can
like the mountain range.
Say it. I'll say it right now. The next show, I will get it wrong again. I don't know why I'm like that, but it trades under the ticker symbol Y, and it's just above its book value currently. There's low volume here, so if you're going to go buy this stock, you want to buy it with a limit order so you don't wind up executing a market order above its current market value if you buy the stock. And I want to put a side note on this. The CEO is what I call a Buffettologist. Person that he looks up to the most is Warren Buffett. And just like Warren Buffett, he writes insightful shareholder letters. They're much worth reading. And just like Warren Buffett, you don't expect quarterly earnings conference calls because they don't do them. Like I said, he's a Buffettologist.
Gotcha. And by low volume, guys, Brandon told me this, and usually in that 5-10 minute time, we can. I had my computer up and I put this in there and I looked at it, and it was 55,000 is the volume.
Yeah, it's very low
right now. That's very light volume. Like I don't like trading light volume companies like that. I try to stick with companies that have at least a few million shares going back and forth every day minimum.
I don't lump all of these companies into value or growth. Just because something's an insurance company or a bank, that doesn't mean that it's at value right now, right? So if you've got a bank at a PE of like 17, that's no longer a value company anymore. If you got a bank with a price to book value of 5, that's no longer a value company anymore. And this trades right almost exactly at the price to book value of 1. And I think it's value right now. And I think it could still rise a lot higher. Back to pre-pandemic, I would say back to pre-pandemic levels in the 800 range if rates start to go higher.
And what's your timeline to hit that 800 range?
I give it about a year.
Okay. All right.
Yeah, it's low volume. It's not very volatile or anything like that. So it doesn't rise. It's not going to go to the moon real fast. But I think it's pretty reliable. So.
Not like Cooler, not like KULR, Cooler. All right. Fair. I mean, it's not like a Tesla where Elon Musk has sell 1.some million shares, and the stock goes up over the week, past 5 days.
He sold 10%, and it made sense that it dropped about 10%. I think it was on Monday, but there were a lot of people there to pick up that dip.
Yeah, everybody wanted that dip, because the company's solid. I mean, everybody knows it's solid, and he kind of foretold this was going to happen. He did it, and boom. But the volume, Allegheny is what you're calling, and it's insurance.
Yep.
Okay, and it's based off the rates. It's based off. You're saying that because a rate hike will probably happen next summer to buy Allegheny now.
And I went fishing for this one because I think a lot of insurance companies and banks have the rate hikes already priced in. And if they don't happen, that's going to be a problem.
Man, when you go fishing, you really go fishing because, You found the root cause of those rate moves way back there this past summer, guys. If you haven't heard that podcast, it was his past summer, and Brandon just took a deep dive down a rabbit hole there, dark rabbit hole, and he found out a Japanese pension fund was behind movements in rates in the United States. And if you need some guy to do your research, call Brandon Beaver.
I love it.
He's up for hire. He's freelancing.
I don't have a job. I'm free to do it. So, okay. Losers in this environment. It'll be the high depth, high growth companies that haven't built their business to scale yet, and they'll have to deal with the coming higher cost of debt. Many analysts will tell you to stay away from tech completely in these situations. That's a mistake. Okay. The best tech companies have some of the best gross margins in the market, and they're able to easily absorb these rising costs. They will group together Microsoft and Apple in with companies like Peloton and Virgin Galactic. And that makes no sense to do it, but they will. And when they do that, oftentimes they drive the price down of Microsoft and Apple to about 10 to 20% off of their yearly highs. And that's the time to buy, because they've got margins that can eat these costs, and they'll be fine in the long term. And they can often pass off those costs to consumers as well. So that gives you a buying opportunity.
So you're basically saying that when the NASDAQ drops as a whole, as a sector, quote unquote, and it takes a big dip down due to inflation concerns and the economy as a whole, look for companies like Microsoft, and you're saying Microsoft's a buy at those opportunities.
And when they lower those bars, they lower the bars for earnings too. So it's offering you a buying opportunity, but it's also offering a great opportunity for that company to beat earnings expectations at the end of the quarter.
Nice. Good call, buddy. Good call.
Another loser, I want you to stay away from the sector of utilities. Utility companies, they're generally capital intensive. They borrow a lot of money. Most electric companies use coal or natural gas to provide power, and they're victims of rising commodity costs as well. You may complain about your rising energy costs and stuff like that, your heating bill or whatever, and you may think, man, they're making a lot of money, but they're really not, because the rising coal and natural gas are hitting their pocketbooks, and there's a lid on how much they can charge you. The political pressure to keep energy bills low for the consumer is high, as are the regulations in this industry. Most of these companies are regulated by the states in which they operate in, and the national companies have to deal with the regulations of each state they operate in, which are often very, very strict.
Yeah, I agree. So not all things are strict. I used to live in a town in Texas, in Lubbock, Texas, where they have multiple power companies, and there was competition on rates.
Well, that's not good for these companies either. It's great for us. It's great for the market. But, Duke Energy, which operates in and I'm not trying to call them out specifically. I'm just saying, like, for example, they operate in multiple different states, so they have to deal with multiple different states and regulations. Now, if they're in Texas as well, not only are they dealing with the regulations from Ohio, Kentucky, Indiana, but they're also dealing with competition in Texas. So it's great for the market. It's great for the consumer, which is best overall to have the competition. But
you get the highest innovation in areas of competition. When there are national companies that run things, they typically do not innovate because they don't have to.
Yeah.
You have to buy from them. You don't get a choice. You have to buy from me. Why should I make this better? I don't need to make it better. I don't need to invest in this company. I don't need to improve my infrastructure. I don't need to do any of that, because you have to buy from me. So competition.
I think we still have the same grid that we. Yeah, sorry, I didn't mean to interrupt you or talk over you there. But why do you think we still have the same power grid that we did in the 1930s?
And people don't get that. It's because in every single city, most cities, in the United States today, not all, but most, you have one power provider, and they have a monopoly in that city. So they don't see a reason why they need to make it better. Yeah. There is none, and then, people are like, well, see, this is why we need more government regulation in these areas. And I'm like, from an economic business perspective, no, You need to just allow competition to come into who will make it better, and then those people either have to change or they're out of business.
Yep.
And that's how it works.
Yeah.
Government
mandated monopolies, they just freeze everything in time and in place.
Competition is what breeds innovation. All right, that's all I got. Final thought, Brandon. Let me go first. I'll give you the last word. Final thought from me, guys, is again, I'm looking at these gaming stocks as a possible long-term play in the meta, but that's not going to move anytime soon. I have a timeline of this of 2 years before any huge announcements or things go live, and you start seeing profits from these VR worlds. So it's a 2-year timeline. You got plenty of time to to investigate, research, do your due diligence, and find the real companies here behind them. One thing I am looking at going in next week is RIOT. RIOT is the ticker. Take a look at it. I'm watching it. I'm not calling a buy, but I'm saying that moves with Bitcoin. There's a lot of movement lately. I made a little bit of money off it this past week. Take a look at it, watch it, add it to your watch list, because when Bitcoin moves, it moves. Brandon?
Yeah, if we get the rising rate environment that I'm thinking we're going to get, high future growth and high depth companies will likely lead the overall NASDAQ and its Invesco ETF QQQ lower. But the already scaled and less speculative companies in the NASDAQ that pass our test at chinchillapicking.com should be able to hold their long-term outlook.
There you go, guys. Follow us on Instagram at Chinchilla Picking. DM us any single time you want. We are also on StockTwits, TikTok. You can find our podcast anywhere. You could just Google the podcast. I mean, you listen to us right now, so you obviously found it. But tell everybody, again, if we hit that 1,000 followers on Instagram by Christmas Day, we will give away a Facebook AR glasses. All right, guys. We hope you guys have enjoyed this time, and we hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.
If you've listened to our podcast before, you know that we are good friends with the Money Vikings, and we think that they have a lot of good knowledge and, just a wealth of knowledge to offer. About 60 years worth of knowledge and trading experience between the three, between Greg, Bob, and Jerry. Now, I have some good news for you, because they have announced a premium program. It's the Money Vikings MVP premium content, okay? And I have to tell you this right now, if you're new to the market, you have got to have somebody to mentor you through it, because 75% of all new market entrants will lose all of their money in the first year, and you have to have somebody that will guide you through it to prevent you from making these mistakes that most people do. And with this MVP access, this premium content, you will get direct access to Greg, Bob, and Jerry on Discord. That's the most important feature of this program, in my opinion. They do also have access, they will give you access to other things such as hot trades, weekly newsletters, technical analysis. Hey, it's ad free. That's cool too, right? Guides and tutorials, tools and custom technical indicators, exclusive analytics and informative articles, and then, as I said, exclusive direct access to Greg, Jerry, and Bob, who have over 60 years of experience between them. Now, if you listen to this podcast, you need to get a pencil, and you need to get a paper, and you need to write this down, because you get 25% off. Once you go to moneyvikings.com and you sign up, you'll get to enter in this code. It's capital TMV P1CK1NS. That is all capital TMV P1CK1NS. An easy way to remember that is TMV Pickens, but the one replaces the I. So go to moneyvikings.com, claim your discount for being a chinchilla picking podcast listener, and conquer your financial freedom.